Hi, welcome to the class. Now in this class we are going to be talking about the 5 styles of forex trading. Now before we continue, I want to say this. In every business there's always value chain. Now let me use tomato paste production business as an example. In tomato paste production business, the manufacturer goes to the farmers where they obtain the raw material, that's the raw tomatoes, which is processed into the paste. Then after the packaging and everything, the wholesaler comes to pick these products from the factory, which he sells to the retailer, and from the retailer it goes to the consumer. Now this is the value chain for tomato paste business. Now value chain in a business helps you to know what level of the value chain you are playing as a business person. Then you play by the rules. Forex is not different. There's also value chain in forex. So these styles of trading has a way of categorizing the type of trader or the style of trading, or you say the value chain of forex trading in which you fall. By the time you identify your value chain or your level in the value chain, you play according to the rules of that value chain, of that level. So let's move to the next slide. Five styles of forex trading. Now the 5 styles of forex trading we have are the high frequency trading, the position trading, the swing trading, day trading, and scalping. Now I've arranged this in terms of hierarchy. Actually this hierarchy starts from position trading, swing trading, day trading, and scalping. High frequency is a type of scalping but on an automated level. We'll explain that as we go into the next slide. High frequency trading. Multiple trades are executed in a fraction of seconds using computer programs and high frequency servers. Now these computers use complex algorithms to analyze multiple markets and execute orders based on market condition. So in high frequency trading, make use of robots, you make use of high frequency servers, so that you can execute multiple trades. You can execute thousands of trades at once. Now a lot of capital investment companies, high level capital investment companies, use this style of trading. So a retail trader that is just starting up may not have the access to these servers or computers, huge computers that are used for this level of trading. Now the trades that are executed on high frequency trading usually are scalping trades. Now based on the algorithms, they can set conditions for entry, for sell, for whatever conditions of execution they want to do based on these algorithms. Position trading. The position trader is a long-term investor. He buys position with the expectation that it will appreciate in value. So what a position trader does is he looks at the chart and decides what price is the best price to buy or sell a pair. Also he listens to the news to look at the long-term view or the long-term trend of a particular pair. Now the news of the day, all the news that come out in the day, does not really bother the position trader if it does not alter the long-term view of the position trader. Then another thing you need to understand is that position traders most of the time trade on the higher time frames. They trade on the monthly and the weekly, because on the monthly and the weekly you can actually look 3 months, 5 months, 1 year into the future and find out the direction of flow. Swing trader. The swing trader attempts to make profits from the distance between the major turning points on the price chart known as swing high and the swing low. Now, swing trading is more of a subset of position trading. The difference is that for a position trader, it may take him a longer time to close up his trade, while the swing trader takes a lesser time. But for a swing trader, he looks at the major swings. These major swings occur on the daily, on the weekly, and the monthly time frame. So when he is able to spot these major swings, he tries as much as he can to take advantage of the moves, of the long moves that will happen as a result of these swings. So he tries to make entries close to the major swings. Now, the holding period of swing trading ranges from a day to a few weeks. Now, looking at this chart to explain swing trading a little more, you find out that we have a swing here and we also have another swing here. This is called the swing points. This is swing low, this is swing high. The distance between them is measured in pips, like we discussed in the previous class. Now, this distance is called the swing body. So what a swing trader does is that he tries to, let's say he wants to go long on this trade. He tries to make entries around this major swing. It may not necessarily be at the swing point, but somewhere close to the swing low, in order to trade it all the way to the swing high. Now, the reason for this is that he can afford, or he has the mental strength to leave his trades longer than the day trader. We're going to explain that of a day trader shortly. So the swing trader will try to make entries around the swing low and allow it to trade for weeks, months, depending on how long it takes the trade to get to the next swing high, next major swing high. Now let's go to the next slide. Day trading. Day trading is a style in which a trader tries to make profit from the change in exchange rate between two currencies in just one trading day. So what it means is that the day trader will only hold his trade for just one trading day. He doesn't allow the trade to stay over to the next trading day. So what it means, he opens the trade in the morning and closes it at the close of the market for that day. This means the day trade, the position is opened and closed within a trading day. The holding period for a day trader spans to just a few hours. It doesn't exceed a day. Scalping. This is a subset of day trading. The difference between the day trader and the scalper is the position holding period. The scalper will just hold his trades for about a few minutes to a few hours, while the day trader holds for longer hours, but it doesn't exceed a day. Now, both the day trader and the scalper most times want to look at the lower time frames, like the 5 minutes, the 15 minutes and more, to make their entries. But the time frame of execution does not necessarily determine the type of trader you are, whether as a day trader or a swing trader. What the determining factor is how long you leave your trades open for. So if as a swing trader you scale down to 15 minutes and make your entry, you are still a swing trader if you have left that trade to exceed 1 day trading activity. That is 1 full day. If it exceeds 1 full day, you are just swing trading. I believe by this explanation you would have understood the differences and the levels in trading, the types of or the styles of trading, the 5 basic styles of trading. So I will see you in the next class. Now, there are things, before I go, there are things you need to take note of. Now, these styles can be traded with different strategies. Example, moving average crossovers, support and resistance, Fibonacci retracement, order flows, etc. So what this means is that the 5 different styles, you can trade it with different strategies. So we will discuss these strategies in details as we go on in the course. Thank you for attending this class. I'll see you in the next class.